Microsoft is working very hard on its AI road, seeing all the potential it has both in the short term and long term future. The move is made from just talking about AI not too long ago towards applying AI at scale. By infusing AI across every layer of the tech stack, Microsoft is winning new customers and helping drive new benefits and productivity gains across every sector, as mentioned by S. Nadella, Chairman and CEO of Microsoft. And in this video, we're going over Microsoft's latest earnings call and use some of the best known valuation models in the world to evaluate Microsoft to see if it's the right time to buy at its current price. Going through the latest earnings report of Microsoft, we can see increases of financials all over the board. Revenue was $62 billion, an increase of 18%. Operating income was $27 billion, an increase of 33%. Net income was $21.9 billion, an increase of 33%. And diluted earnings per share was $2.93, also an increase of 33%. Microsoft has been working for months on the acquisition of Activision Blizzard, known for its popular games like Diablo, Overwatch and most of all World of Warcraft, and finally finished this on October 13th, 2023. The starting dividend yield is only 0.74%, which isn't looking impressive at all, right? Well, next to the low yield, the dividend growth rate is phenomenal. When we go over to my Google Sheets and look at one of the models I've built, we can see a 3, 5 and 10 year CAGR of almost 10%. This model is used to calculate the sustainability of dividend payouts and the free cash flow. And one of the models we're going to use to calculate Microsoft's stock price later in the video. Dividends are paid out of free cash flow, and only a small percentage of the free cash flow is used to pay out dividends. Dividends isn't the only way for a company to return money to its shareholders. Besides dividends, a company can also choose to buy back shares. This causes the fact that your share in a company becomes greater and greater, making your ownership larger. Here we can see that Microsoft uses billions of dollars to buy back shares every year. This decrease in amount of shares causes it so less shares have to be divided by the market cap of Microsoft, making the stock fly high, looking at the total price history. So, looking at the latest financials, we can say that Microsoft is doing very well for themselves and returning billions of dollars to their shareholders. So knowing all this, let's evaluate Microsoft and see what it's actually worth. Please do me a favor and like and subscribe to the channel so we can quickly hit 69,000 likes.
You serious?
Or just 7. So the first valuation model I want to use is the discounted cash flow model. This model predicts the future free cash flows and calculates the present value, giving us the stock price. By plugging in the historical free cash flow over the last decade, we can use this data to calculate the future free cash flow using a growth rate of 11%. This growth rate estimated based on analysts' expectations and the performance of the industry. For the terminal value, we make use of the discount rate of 7.5% and the perpetual growth rate of 4%, which is usually the rate the economy grows, but seeing how future-oriented Microsoft is, we make use of a premium. Now that we have the future free cash flows, we add them all together. By adding up the cash and cash equivalent and subtracting the total debt, we find the equity value. Dividing this by the total amount of shares outstanding, giving us a stock price of $386.13. Next up is the dividend discount model. This model uses future dividend payments discounted back to its present value in order to determine the value of a company. We plug in the historical dividend payouts, giving us an average rate of 10.27%, using a discount rate of 7.5% and a growth rate of 6.75%, which I think will be sustainable for the long-term future. We can calculate the stock price, giving us a price of $427. The third valuation model we will use is the multiples valuation model, which assumes that similar companies should be valued the same. Companies that are similar are Google, Amazon, Apple and Meta. Plugging in their stock price and EPS, earnings per share, gives us a PE ratio, price to earnings ratio. We use the average and also the earnings per share of Microsoft in order to calculate the stock price, coming to $351.98. I don't just want to evaluate Microsoft using other companies, but also compare Microsoft to itself. So let's take it a step further. I want to know how the PE ratio has been doing over the past decade. The thought behind the PE is as follows. The PE ratio tells an investor how much he is willing to pay for every dollar of earnings of the company. So with a PE of 37.1 in 2024, an investor is willing to pay $37.10 for every dollar the company earns. So the lower the PE, the better. The last model I want to use is Graham's valuation, the mentor of the great oracle of Omaha, Warren Buffett. Graham calculates a stock value by taking into account the EPS and current market conditions and calculates the upper bound of the price range an investor should pay for a stock. Throughout the years, this model has been revised many times. In order to calculate the intrinsic value, we take the earnings per share forward-looking, multiply that by 7 plus the projected growth rate 12, which is based on analysts' expectations, multiplying that with 4.4, the average rate of AAA bonds, dividing this number by the current yield on AAA bonds, 4.87%, we come to an intrinsic value of $200, which to me is on the lower end as this model is very reliant on the yield on AAA bonds. When we would have evaluated Microsoft using this model, say in 2020, the yield would be only 1.4%. When you plug that into the formula, the value would change a lot, to almost $700. After having calculated the intrinsic value using numerous valuation models, we come to a stock price of $341. This is below the current market price of $410. But there are a few things that heavily influence the valuation of some methods, like the current yield on AAA bonds in Graham's method. When we take out Graham's valuation, we come to an intrinsic value of $388, still below the current price. For the market price to get to the intrinsic value, according to these valuations, the market price has to drop by 5.57%. This doesn't mean you can't buy Microsoft. I have put Microsoft on my watch list as I want to buy some shares when it drops down to more like the $350 range. When we use a margin of safety of 10%, suggested by the great Benjamin Graham, the stock price has to drop almost 20%. So there you go, a quick valuation on one of the biggest companies in the world, Microsoft. Before you decide to buy in or not, please do your own research and let me know in the comments down below what you think of the stock. If you made it this far into the video, please consider subscribing to the channel. Thank you so much for watching and I'll see you in the next video.